Today on the Chad Slagle Show, coaching you to and through retirement.
We are going to discuss why the next market downturn may blindside you.
And on our Coach's Corner, we're going to go over why you cannot trust today's markets.
And on our Chalk Talk segment today, we're going to show you some strategies to protect yourself now from the next bear market.
So sit back, relax, and learn. The Chad Slagle Show starts now.
I'm Chad Slagle. I believe financial planning is about educating people and empowering them to make better decisions with their hard-earned dollars. Coaching gives me satisfaction from watching a player succeed and get better. You need an experienced team around you. The best coaches have great assistant coaches. I have brought a lot of the techniques and structure I learned from playing and coaching football and apply them to the world of investing. My goal now is to coach as many individuals and families as I can on how to get successfully to and through retirement.
Welcome in, everyone, to the Chad Slagle Show, coaching you to and through retirement. I'm Wendy Erickson here with the coach, Chad Slagle. Today on the Clipboard segment, we're going to discuss why the next market downturn may blindside you.
That's right, Wendy. You know, with everything going on in the world today, many of us are callous to all of the bad news. So it's nice to focus on the good news for once that has been coming from Wall Street lately. You know, the market seems to only be going up and is hitting all-time highs almost on a weekly basis. Since the major correction of 2020, the recovery, of course, has been incredible. And it now seems that the world has found its new normal, if you will, and Wall Street is back to business as usual. Because of the bull market we've been in for the past year, it's very likely that you have earned back what you lost in 2020 and are feeling pretty good about your retirement nest egg right now. However, too much of a good thing can breed overconfidence, and that's what we're going to talk about. And that's what we see today when we sit down with clients and prospective clients. Yes, the market has more than recovered from last year's dive, but this does not mean it will happen again. What goes up, of course, as we always say, must come down, and the next bear market is inevitable. There's no guarantee that the market will recover like it did in 2020, and it's easy to get greedy in times like this and take on more risk than you really need to be, more than what's necessary. But if you're getting close to retirement or are currently retired, it's important to protect the majority of that nest egg instead of being aggressive in today's market, no matter how tempting that may be when we see these new highs each and every week.
My mom used to tell me, save your money for a rainy day, right? We hope there are mostly sunny days out there. And as a kid, obviously, it's more fun to play outside in the sunshine. And the rainy days mean you're bored and sitting inside. But if you've got your money saved for that rainy day, and then you have it when you really need it. And I think it's a sort of what you're talking about, I guess, here today.
Absolutely.
Yeah.
You know, as you get closer to retirement, you want to make sure that money's preserved. Yes, it's nice to make those 10, 20, 30% gains, but we also want to make sure we're protected from those 10, 20, 30% losses. As we say, what goes up, of course, must come down. And of course, the next bear market will likely blindside many individuals because they are too trusting of the market after the 2020 recovery. It is wishful thinking to believe that because you bounce back from 2020, then you can weather the next market storm. And it's extremely important to make sure your nest egg is protected. So today, we're going to go over some strategies and ideas you can use to make sure you are prepared for the next market downturn. Still have money in the market, but make sure if the market goes down, that your nest egg is protected for retirement.
Being prepared is the key.
Absolutely.
And as we've always talked about on the show, it takes some homework. You got to put a little time and
homework
effort into it.
Homework and planning, absolutely.
All right, well, we have more on today's show when we return. On the Coach's Corner, we're going to go over why you cannot trust today's markets. Stay with us.
The number one concern of retirees today is outliving their hard-earned dollars. It is more important now than ever to educate and empower yourself to make better decisions with your monies that it has taken you 30 to 40 years to accumulate. How do you do this? By using our Financial GPS, our guided planning system. This is a 4-step process to help get you successfully to and through retirement. The first step in this process is to create clarity. Here we will help identify your goals as well as your concerns and identify what you want to accomplish in retirement. The second step, we will analyze the risk you're taking with your current portfolio, and this step will also identify exactly what you are paying in fees. In the third step, we will evaluate and assess your current plan and help identify the gap between the missing pieces. And in the fourth and final step, this is where we will work together to implement a plan of action to accomplish your retirement goals. And this process can take place at any one of our convenient locations, so call now to get set up on that right path on your journey through retirement.
Welcome back to the Chad Slagle Show, coaching you to and through retirement. We are back with the coach, Chad Slagle, and his colleague, Chad Tobin. And today on the Coach's Corner, we're going to discuss why you cannot trust today's markets.
That's right, Wendy. A bear market is a term describing a period when the stock market experiences a decline of 20% or more over a short period of time. Unfortunately, they are inevitable. They happen and they're part of investing. On average, a bear market can be expected once every 3 years. And according to Investopedia, the bear market that started in March of 2020 began due to a number of factors, including, of course, the extremely unusual length of the 11-year bull market that preceded it. But the immediate cause of that bear market was a combination of worries about COVID-19 on the world economy and unfortunate price war, of course, in the oil markets. Again, the average amount of time between bear markets is 3 years, so it is very unlikely we will see another 11-year bull market anytime soon. You cannot trust the market, and with uncertainty becoming the new normal in our world today, it's important to educate yourself so you can be prepared when the next bear market strikes and hits.
Yeah, and I think, when we sit down with prospective clients and even some clients now, we see a lot of people wanting to take on more risk now because of the most recent bear market. And this is something that when we talk about 2008 or even most recently 2020 last year, all of a sudden they step back and they don't want to go through that again, or they try not to think about it. So it's so important to really make sure that you're comfortable with the amount of risk you're taking and really prepare yourself for the next bear market.
You two talk a lot about how risky that the market can be for retirees. What are some of the problems that you see when you sit down?
Well, the
with investors?
number one problem, Wendy, is too many people are naked in the stock market. It's currently, of course, very tempting to get a little more aggressive and want to take some risk because it seems like the market has only been going up the past several months. But when you get closer to retirement, you have to shift your focus and realize you have different priorities. You are no longer in that growth mindset. You must focus on the preservation of the assets you have earned over the past 30 to 40 years. And we meet with a lot of people who are completely naked, though, in the stock market. They have no stop loss, no covered calls, no hedge funds, nothing. A lot of them are completely naked in the stock market with all of their life savings. And why they have left themselves exposed and vulnerable in this way? It's because they sat down with an advisor who has no clue about preservation. And now I'm not telling you that you should never take risk, but you do need to educate yourself and know what you stand to lose in the next market correction. Know, hey, if this market, Chad, has a 20 to 30% correction the next year, the way that I'm set up right now, how much will I lose? And once you find out what that number is, most of the people that we sit down and show them that number, it completely blows them away.
Yeah, absolutely. I mean, we all want our money to grow, and we're all a little greedy, right? We're human. But at the end of the day, now as you're getting close to retirement, now is not the time for you to continue to take on that amount of risk that you were taking when you were 40, 50 years of age. So it's time to really understand your risk tolerance and how much exposure you have.
You're talking to me, so I need to always
We're
listen
speaking
to
your
what
language.
You're speaking my language. There was a time in my life where I could be a little more risky with that, and now
Right.
getting closer than I'd like to admit to as a pre-retiree. So what's another problem, a common problem that you see when you sit down with people?
Well, market misconceptions. The market is currently hitting record highs left and right, as we mentioned every week. And a recent article from the New York Times stated that the S&P 500 index is up over 20% for 2021 and has more than doubled in value since it hit its bottom in March of last year. And one of the most surprising of market statistics is that as of September 1st, it has closed at a record high 53 times in 2021. And that is the most it has closed this early in the year since 1969. Now, the market has recovered well since March of 2020, and many investors are getting comfortable, but this cannot last forever. The Fed recently said it intends to keep rates low, but will soon begin to taper the money printing and bond purchases that have fueled the economic recovery. According to an article in the New York Times, analysts believe that as the Fed begins this tapering, it is likely that growth will start to decelerate. And unfortunately, the longer the market rises, the worse the sell-off could be. And it's something, and we're seeing a lot more red flags with economists and analysts and what they're saying. So our thing is, you just need to be prepared.
Yeah, and I think there's so many things out there that we can't control when it comes to us as investors and the stock market with that meaning. So as an investor, as a retiree, you have to really make sure your portfolio is set up in a balanced manner so you're prepared and be able to take advantage of good times, but most importantly, that preservation mindset to protect what you've built.
Any other common problems that we should avoid?
Well, number 3, having that maybe income plan. You know, many of you out there are getting ready to retire, already retired, and have a lot of your money sitting in the stock market. And maybe your game plan is to follow what we call the 4% withdrawal rule. The idea behind this rule is if you have $1 million saved, that means you need to draw approximately $40,000 a year from your investments to live comfortably. But let's say the market has a correction and drops 25% the next year, and that $1 million now turns into $750,000. Now you have to draw out almost 5.5% just to get that same $40,000 a year. And I recently sat down with a couple in our office, and they'd been watching the TV show and called in to meet with us, and they were hoping to retire early with the amount of money they had saved. This was a possibility. However, when I took a look at their portfolio, the majority of their money was at risk, had a very high risk number. So let's say they plan to retire in 6 months and then they kept their money where it's at. If the market takes a hit, it's very likely they would have to readjust their retirement timeline and work longer than they hoped, probably another year, year and a half. And many retirees believe they have a solid plan set up with an income stream they can never outlive, when in reality, the plan their advisor has created is what we call a maybe plan. It might work, but it might not.
Yeah, and I think, none of us have any idea how long we're going to live, and that's the challenge. However, you don't want to have, when you're building this retirement plan, when you're building that income stream in retirement, you don't want to have that maybe income plan. You want to know that there's a piece of that portfolio that's going to pay you every month for the rest of your life and your spouse's life, no matter how long you live.
So if people out there have more questions about what we're talking about, how can they get a hold of you?
Well, of course, anytime you have questions or things that we talk about here on the show, you may have realized, we encourage you to schedule a meeting. To do that, just call us at the number below, 888-294-9248.
And we have more ahead on the show today. Stay with us. We'll be right back.
Let's go.
He's such an involved dad. He's always telling the kids stories. I remember when so-and-so said I couldn't do this, or I didn't make this team. That's what drives him. In our family, we always tell our kids to stick up for each other, stand behind one another. He feels it's his role to provide, keep us safe, and to make sure that the kids are taken care of. A lot of Chad's clients have the same traditional values, and he bonds with them. Each family has a different set of circumstances, and each family is unique and different. The common thread between all of Chad's clients is that they want the best for their family, just as he would our own family.
Welcome back once again to the Chad Slagle Show, coaching you to and through retirement. So we just discussed why you can't trust today's markets. Now we're going to show you some strategies to protect yourself now from the next bear market.
You know, Wendy, the main thing I want all of you to take away from today's show is you have to be proactive and be prepared for that inevitable market correction. You cannot be reactive when it comes to your retirement. That is this is a quick way, of course, to run out of money. And the best time to be proactive and prepare for a bear market is when a bull market has been running for a while and it's hitting record highs and you've made good returns on your investments. And this is the exact situation we are in at this moment. There have been more record-breaking days this year than we have have seen in decades. And this, of course, causes investors to get greedy and comfortable. But as soon as the market takes a big hit and we enter a bear market, everyone will begin to panic. You must protect yourself now and make sure that your portfolio is set up correctly. If you do not, you may lose a big portion of your nest egg. You may have gotten comfortable in the market over the past year, but it is time to make sure you are prepared. You cannot afford to lose sight of the amount of risk in your portfolio. Also, Chad, that's something you want to make sure that you continue to rebalance every 3 to 6 months as well.
Yeah, and I think no matter if it's business, whether it's sports or even your personal life, I think it's the markets, we can't get overconfident because a lot of times when you start feeling overconfident, that's when something's going to come and basically put you right back in. So what we're seeing now is with the markets, don't get overconfident, and we're going to show you some ways to really build that balanced plan so you have peace of mind whether the markets are good or bad.
You know, you got the sports analogy, don't get that big head because something will happen and you'll get humbled pretty quick.
We don't want to get humbled in our retirement.
No, we don't.
Okay, so you say be prepared. How do we be prepared?
Well, number one, how to allocate your 401k or retirement accounts. You know, as you get closer to retirement, you need to make sure you are protecting the money you have worked all your life to accumulate. And a strategy we like to recommend is separating your money into 2 buckets, what you have made and what you could make. The first bucket is what you've made. Say you have a 401k of $500 or $750,000. Now, that is money that you have made. So you do not want to continue to risk that money. Move that money into more conservative or more secure accounts. Then the second bucket is what you could make. This is the money that you're pumping in every pay period. You can take more risk with this money because you can invest that as the market goes down, and when the market comes up, then you're going to have an even bigger gain. So it's okay to risk some of that money, but do not risk the money that you've already made.
Well, and I think this is important because a lot of retirees out there, they're still working. They turn 59 and a half, and this is a big, it's almost a birthday for you because this gives you the opportunity to do what Chad just mentioned. If you have that $1 million in your 401k, make sure now you're looking at that, this is money I've made, and be able to do an in-service withdrawal to do some planning and build a game plan so you protect that money, and now you're dollar cost averaging and being more aggressive with the new money every paycheck.
Well, I know some people at home can relate. I've been putting money into my 401k since my very first job out of college, since I was 22 years old. I don't want to lose that money. I wasn't sure at the time why I would need that, but I do know now as I face retirement. What's another strategy to help me keep my money?
Number 2, the rule of 100. According to a recent article in MarketWatch, many analysts believe that as the market has risen over the past several months, the risk side of that risk-reward equation has grown substantially, meaning the market is getting riskier and a drop is likely on the horizon. To prepare for this, we will have a rule of thumb we like to use to determine how much money you should have at risk and how much you should have where it's secure or safe. It is called the Rule of 100, and this was created by John Bogle, the founder of Vanguard. You take 100 minus your age. So if you're 60 years old and you subtract 60 from 100, you get 40. So 60 is how much percentage-wise you should have secure, so that if the market experiences a 20 or a 30% correction, it won't matter because that money is secure. Now, the other 40% should be in riskier investments where the money can grow because it's there for the long term. So according to the Rule of 100, that 60-40 ratio would be your safe risk ratio. This, of course, is not cookie cutter. It's not for everyone, but it is a good place to start. It's a good place to start that outline, Chad.
Well, and I think, why is it such a good place is because it's different. We're so used to when we're 30, 40, 50 years of age working, just pumping money into the 401k, grow at all cost, and now all of a sudden you're getting ready to retire. This is a great starting point to sit down to really, truly understand how comfortable you are with a market correction and how it would affect your portfolio. So, just something different, starting that new planning for retirement is going to be huge.
All right, and what is the final strategy you want to let people know about to prepare?
Well, of course, as you get closer to retirement, as you start to prepare for retirement, you are going to be to the spot where you can retire, not have to go to work anymore, but still you're going to get a paycheck coming in each and every month, which is hard for a lot of people to believe. As we talk about on this show all the time, we're currently living in a pensionless society. You will no longer have that paycheck coming in, so it is up to you to make sure you create your own retirement paycheck. So what are some things to take a look at? Number 1, Chad, you have to think about what kind of lifestyle do you want to have in retirement. When you're 3 to 5 years out, or now that you're retired, what kind of lifestyle do you want to have in retirement? Do you want to travel? Do you want to have an RV? Do you want to have a second home at the lake or on the beach? So you really have to think about what is that lifestyle.
And once you understand, what your goals are in retirement, I think now all of a sudden we can start talking about the number. What do we need? How much money have we saved? And what kind of income are we going to need from our money? It's not about how much, what's that number? Do we need to have $1 million? But it's more about the income number that we have to draw from those investments.
Yeah, you have to think about, is it $1,000 or $7,000, let's say, and you only have $4,000 coming in from Social Security and maybe a small pension. That means you have a $3,000 a month shortfall that you need from your investment. So as you mentioned, Chad, it's not that total number, it's more of that monthly income number to support that lifestyle. And then also, once you know those numbers, then you can properly structure that portfolio to meet those numbers.
Yeah, and this is what we talked about in that risk-safe ratio, building your comfortable risk-safe ratio, making sure we don't have a maybe income plan, we have an income that's going to last throughout the rest of your life, and understanding if we go through another market downturn, how much you're comfortable losing of things that we can't control.
Good information, gentlemen. In order for those of you watching out there to make sure your retirement is on the right path, Slagle Financial has educational events coming up in your area. To sign up for one of these events, call the number below, 888-294-9248. When we come back on the strategy play, the Chads are going to show you how they address the two biggest concerns of retirees today. Stay with us. We'll be right back.
The number one concern of retirees today is outliving their hard-earned dollars. It is more important now than ever to educate and empower yourself to make better decisions with your money that it has taken you 30 to 40 years to accumulate. How do you do this? By using our Financial GPS, our guided planning system. This is a 4-step process to help get you successfully to and through retirement. The first step in this process is to create clarity. Here we will help identify your goals as well as your concerns and identify what you want to accomplish in retirement. The second step, we will analyze the risk you're taking with your current portfolio, and this step will also identify exactly what you are paying in fees. In the third step, we will evaluate and assess your current plan and help identify the gap between the missing pieces. And in the fourth and final step, this is where we will work together to implement a plan of action to accomplish your retirement goals. And this process can take place at any one of our convenient locations, so call now to get set up on that right path on your journey through retirement.
Welcome back to the Chad Slagle Show, coaching you to and through retirement. On this week's strategy play, we're going to discuss the two biggest concerns our clients and prospective clients have when they sit down with us. Number one, do I have enough money to retire? And number two, can I retire on time? To answer these questions, we must understand and answer the question of income. How much do you have to have coming in each and every month or each and every year to be able to live comfortably and support that lifestyle throughout the rest of your life? So if we take a married couple here, and let's say you're lucky enough to have $1.5 million sitting in your nest egg, and you need about $60,000 a year to live off of, that goes right in line with what we call the 4% withdrawal rule. So if you're lucky enough to make at least 4% each and every year. The key is, though, Chad, what we see with a lot of clients and prospective clients is, because of the market and where it is at right now, a lot of that money's invested in the market. And the problem is, if the market has a 20 or a 30% correction, your $1.5 million just turned into $1 million.
Yeah, and I think, when we're sitting here, a lot of us right now, that 1.5 number, we're happy. Maybe we're a little bit arrogant. We're greedy. We wanted to maybe hit that 2 million, but all of a sudden, if we lose just a 30% correction, that's $60,000 a year. That was just a 4% withdrawal rate. Now, we still need $60,000 a year off of a little over $1 million now. So it drastically changes our withdrawal rate. And now we have a lot of fears of running out of money.
And the other thing, Chad, we talk about that 30% correction. That means you have, about 7 years. You've lost over $450,000 just in that one market correction, which is over 7 years of income. So the income you need now to still get that same $60,000 a year, you have to make each and every year over 7% just to get that same amount of money coming in.
Yeah, and I would say a great question is, what's more important, taking that $1.5 million to $2 million, or making sure that you have $60,000 a year coming in for the next X number of years throughout the rest of your life?
Yeah, it doesn't matter if you live to be 75, 85, or 105. If you set it up properly,
That money will last. That $60,000 plus inflation will come in each and every year for the rest of your life and the rest of your spouse's life. Do you know how much risk you're currently taking right now in your portfolio? Are you sure you have that income stream, those paychecks set up that you can never ever outlive? If you're having doubts, I encourage you to give us a call today, and that's this week's Strategy Play.
To get more detailed information on these strategies and how they can work for you, call the team at Slagle Financial now to schedule your 5-point inspection. The number is 888-294-9248. And we will be right back with some of the key takeaways from today's show.
I'm your host, the coach, Chad Slagle, and joining
I'll be with you guys in just a few minutes.
When it comes to your health, your life, your family, your home, and your hard-earned dollars, of course you want to make sure you're working with that sharp, energetic, knowledgeable individual that is always looking out for your best interest.
Such short notice, appreciate it. Thanks.
It's time to get your financial house in order. This is the new age of retirement planning. In the Wall Street world, that's what they talk about. You got to have
Now back into the Chad Slagle Show, coaching you to and through
We
retirement.
are Slagle Financial. Call now, 888-294-9248.
Welcome back to the Chad Slagle Show, coaching you to and through retirement. We have covered a lot of ground today. What would you say are some of the key takeaways, Chad?
Number one, Wendy, is be proactive, not reactive when it comes to your retirement plan. You do not want to be chasing the markets and gambling with your nest egg. Number two, prepare for the next market, a bear market. Don't be fooled by what is currently happening in the market today. And number three, create your retirement paycheck by using that safe risk ratio, which helps develop a secure bucket that you can never, ever outlive.
All right, and Slagle Financial and their team of advisors have educational events coming up in your area to make sure you are prepared for today's retirement. To sign up for one of these events or to schedule a meeting with Slagle Financial's team of advisors, call 888-294-9248.
Remember, folks, success is waking up in the morning, whoever you are, wherever you are, no matter how old or young you are, and bounding out of bed because there's something out there that you love to do, that you believe in, that you're good at, and you can hardly wait to get at it again today. At Slagle Financial, we realize that it is bigger than our team. It's about educating you, the public, and our wonderful clients, and empowering you to make better decisions with your hard-earned dollars. For my colleague Chad Tobin and my co-host Wendy Erickson, this is the coach, Chad Slagle. Thank you very much for joining us. We look forward to visiting with each and every one of you next week.